Welcome to our exploration into the world of Forex trading instruments. Today, we're going to delve into the range of instruments used in Forex trading. These instruments are the tools that traders use to participate in the dynamic and exciting world of foreign exchange. First up, we have traditional spot transactions. These are straightforward trades where one currency is bought or sold for another, and the exchange happens on the spot. This is the most direct way to trade currencies, and it's where many traders start their Forex journey. Next, we have currency futures. These are contracts to exchange one currency for another at a specified date in the future, at a price agreed upon today. Futures allow traders to lock in a price for a currency, which can be particularly useful in volatile markets. Options are another instrument used in Forex trading. Like futures, options are contracts, but they give the holder the right, not the obligation, to buy or sell a currency at a predetermined price. This gives traders more flexibility and potential for strategic trading. Then we have exchange-traded funds, or ETFs. These are investment funds that are traded on stock exchanges, much like individual stocks. There are many different types of ETFs, but for Forex traders, currency ETFs are a way to gain exposure to currency movements without having to buy the currencies directly. Contracts for difference, or CFDs, and spread betting are two more instruments that Forex traders might use. Both allow traders to speculate on price movements without owning the underlying asset. They can offer high leverage, but also come with high risk. These are just a few of the many instruments that Forex traders use to navigate the markets. Each one has its own unique characteristics and applications, and traders often use a combination of instruments to create a diversified trading strategy. With these instruments, traders have a variety of ways to engage in the Forex market. Now, let's move on to understanding the value of currencies in our next segment. Now, let's discuss what determines the value of currencies in Forex trading. Currency values are influenced by a multitude of factors. It's like a giant global seesaw, where the rise and fall of currency values reflects the ebb and flow of economic circumstances. Firstly, let's look at economic indicators. These are like the pulse of a country's economy. They include elements such as gross domestic product, unemployment rates, and retail sales. For instance, if a country's economic health is robust, with high employment and strong retail sales, its currency value is likely to increase. Next, we have central bank policies. These are the big decisions made by a country's central bank that can sway the value of its currency. Changes in interest rates, fiscal policies, and even public statements by central bank officials can cause significant shifts in currency values. Political stability also plays a critical role. A stable political environment tends to foster a strong economy, resulting in a more valuable currency. Conversely, political uncertainty or turmoil can lead to a drop in currency value. Finally, we can't ignore overall market sentiment. This is the general attitude or feeling of investors towards a particular currency. If investors are optimistic, they buy, and the currency value goes up. If they're pessimistic, they sell, and the currency value goes down. Keep in mind that these factors don't operate in isolation. They're intertwined, each influencing the others in a complex dance of cause and effect. And while the precise impact of each factor can be hard to predict, understanding their general influence can give you a significant edge in the Forex market. Also, remember that Forex trading isn't just about understanding the value of individual currencies. It's about understanding how these values relate to each other. Because in Forex, you're always trading one currency against another. These factors are key in understanding the movement of currency values. So, as you embark on your Forex trading journey, don't just watch the numbers, watch the world. Because the world is what moves those numbers. Exchange rates are more than just numbers. They tell a story about a nation's economic condition. This statement might seem a bit puzzling at first, but as we delve deeper, you'll see the truth in it. Exchange rates are like a barometer, measuring the economic health of a nation. It's a constantly fluctuating index, mirroring the ebbs and flows of a country's economic climate. But what causes these fluctuations? Let's break it down. First off, we have interest rates. When a country's central bank raises its interest rates, it often attracts foreign investors looking for higher returns. This increased demand for the country's currency can cause its value to rise, hence affecting the exchange rate. Next, we have inflation rates. Generally, a country with lower inflation rates will see an appreciation in the value of its currency. Why? Because lower inflation rates mean increased purchasing power. And who doesn't want a stronger currency? Last, but certainly not least, we have political stability and performance. Stability brings predictability, and predictability is attractive to foreign investors. When a country is politically stable, it's more likely to attract foreign capital, which in turn increases the demand for its currency, and thus, its value. But remember, these factors don't exist in isolation. They're interconnected, each influencing and being influenced by the others. It's like a complex dance where every step matters, and missing one could change the entire performance. So as you can see, exchange rates are far from arbitrary. They are a reflection of a country's economic health and stability, influenced by various factors like interest rates, inflation rates, and political events. They're a window into the global economic landscape, offering insights that are valuable for traders and economists alike. As such, keeping an eye on exchange rates can give us valuable insights into global economic conditions. They allow us to anticipate market trends, make informed trading decisions, and navigate the ever-changing world of Forex trading with confidence. Let's shift our focus to major currencies in Forex trading. At the heart of the Forex market lie the major currencies, key players that dominate the trading floor. These stalwarts include the United States dollar, the euro, the British pound, the Japanese yen, the Swiss franc, the Canadian dollar, the Australian dollar, and the New Zealand dollar. Why, you may ask, are these considered major? Well, it's all about liquidity and volatility. In simpler terms, these currencies are easily bought and sold in large amounts, and their exchange rates don't fluctuate wildly. This makes them attractive to traders, particularly those just starting their Forex journey. Now let's delve a bit deeper into these major currencies. The United States dollar, or USD, is the most traded currency in the world, often acting as the intermediary in triangular currency transactions. It's like the popular kid in school. Everyone wants a piece of the action. Next up is the euro, the official currency of the Eurozone. It's the second most traded currency after the USD, and it represents a significant portion of the world's economic activity. The British pound, fondly known as the cable, is one of the world's oldest currencies still in use today. Despite the ups and downs of British history, the pound remains a heavyweight in the Forex market. The Japanese yen, Swiss franc, Canadian dollar, Australian dollar, and New Zealand dollar also have their unique places in the Forex market, each offering different opportunities based on their respective country's economic health and geopolitical events. For beginners, the appeal of trading major currencies lies in their predictability. Their high liquidity means you can buy or sell them quickly, and their generally lower volatility provides a level of stability. It's like learning to swim in a pool before diving into the ocean. The environment is controlled and the risks are manageable. Remember, while the Forex market can offer great opportunities, it also comes with inherent risks. So it's essential to understand the dynamics of each currency before you start trading. For beginners, trading major currencies can be a safer bet due to their stability. Understanding ISO currency symbols is crucial for accurate Forex trading. Now, this might seem like a given, but you'd be surprised how many traders gloss over this crucial aspect. So let's dive right in. In the world of Forex, each currency is represented by a unique three-letter ISO code. ISO stands for International Organization for Standardization, the body that sets these codes. The first two letters denote the country, while the last letter represents the currency. For example, USD stands for United States dollar, GBP for Great Britain pound, and JPY for Japanese yen. Now, why is this important? Well, imagine you're looking at a Forex trading screen, and you see a pair like USD JPY. This pair represents the exchange rate between the US dollar and the Japanese yen. In other words, it tells you how many yen you can get for $1. If you mix up the symbols, you could end up trading the wrong currency pair, which is a surefire way to lose money. Furthermore, understanding these symbols helps you keep track of economic news and events that could impact the value of a currency. For instance, if you're trading EUR-USD, you need to be aware of events in both the Eurozone and the United States. It's also worth noting that some currencies have nicknames. For instance, the GBP-USD pair is often referred to as cable, a throwback to the transatlantic cable used to transmit currency prices between London and New York in the late 19th century. However, these nicknames are more of a trader's lingo and aren't officially recognized by the ISO. In summary, understanding ISO currency symbols is a fundamental part of Forex trading. It's like the alphabet of the Forex world. You need to know it to read the market, interpret news, and most importantly, make trades. So remember, when it comes to Forex trading, don't just focus on the numbers. Pay close attention to the letters too. Knowing these symbols can be the difference between successful and unsuccessful trading. Currency trading has a long and storied history. It's a tale that begins in the ancient world where goods and services were exchanged in barter systems. This was a time when the value of items was relative and trading was often a matter of negotiation. From there, we travel to the kingdom of Lydia in the 7th century BC, where the first coins were minted. These coins, made of a metal alloy called electrum, revolutionized trading by offering a standardized measure of value. This was the birth of currency as we know it. As empires rose and fell, so did their currencies. The Roman denarius, the Byzantine solidus, the Islamic dinar. Each of these currencies played a crucial role in their respective societies, facilitating trade and symbolizing power. Fast forward to the Middle Ages, and we find the first forms of paper currency in China. The convenience and practicality of paper money made it an immediate hit. It wasn't long before this innovation spread to the rest of the world. The modern era saw the establishment of national banks and the introduction of official national currencies. This period also saw the birth of the gold standard, a system where the value of a currency was directly linked to gold. This system played a significant role in global economics until the mid-20th century. The post-World War II era brought with it the Bretton Woods system, establishing the US dollar as the world's dominant reserve currency. This system paved the way for the modern Forex market, where currencies are traded freely at floating exchange rates. Today, the Forex market is a bustling, sophisticated arena where trillions of dollars change hands every day. It's a far cry from the barter systems of our ancestors, yet the fundamental principles remain the same. We trade value for value, seeking to gain from the fluctuations and trends that shape the global economy. Understanding the history of currencies can give us a deeper appreciation of the Forex market today. Every industry has its jargon, and Forex trading is no different. In this bustling world of currency exchange, traders have developed a unique lingo, filled with colorful slang and nicknames that add a dash of character to the otherwise numerical landscape of Forex. Let's dive into some of the most common terms. For starters, the US dollar is often referred to as buck, stemming from the days when deerskins were a common medium of exchange. The British pound, on the other hand, goes by cable, a throwback to the transatlantic cable used to transmit currency prices between the New York and London exchanges in the late 19th century. Moving on, we've got the euro, playfully known as the fiber, a term that has no historical significance but is believed to be a counterpart to cable, representing the fiber optic cables used in modern data transmission. Similarly, the Japanese yen is called the yen, but when it's paired with the US dollar, it becomes the ninja. Some nicknames get even more creative. The Canadian dollar and US dollar pair is called the loonie, named after the loon, a bird featured on the Canadian $1 coin. The New Zealand dollar and US dollar pair, on the other hand, is known as the kiwi, a nod to the national bird of New Zealand. These terms are more than just linguistic quirks. They represent the cultural richness and diversity of the Forex market, and knowing them can help you blend into the trading community more easily. But remember, while these nicknames add a fun element to trading, they should never distract from the serious business of analyzing and understanding market trends. After all, Forex trading is a game of numbers, strategy, and careful observation. So, the next time you hear someone talking about trading the loonie or the cable, you'll know they're not discussing wildlife or telecommunications. They're deep in the world of Forex. Knowing these terms not only makes you sound like a pro, but it also helps in understanding market conversations. We've reached the end of our journey through Forex trading instruments. Our exploration took us from traditional spot transactions, currency futures and options to exchange-traded funds. We delved into the unique world of contracts for difference and spread betting and how they fit into the Forex trading landscape. We shed light on the factors affecting currency values, including economic health indicators and central bank policies. We also discussed how exchange rates reflect a nation's economic condition and the benefits of trading major currencies. Then we decoded ISO currency symbols and their vital role in accurate trading and took a brief historical tour of currency development. Lastly, we familiarized ourselves with the colorful slang and nicknames that enrich the Forex trading culture. To solidify your understanding, we encourage you to take the quiz from Chapter 1, What is Forex? Completing this will mark the end of Lesson 2, paving the way for Lesson 3, Navigating Currency Pairs in Forex Trading. Thank you for joining us on this journey. We look forward to seeing you in Lesson 3, Navigating Currency Pairs in Forex Trading.